All right. We'll just let these disclosures run for 1 sec and we will get rolling. All right. And we are live. All right. Welcome. Just check out the disclosures here. They've been running just for a sec. And we'll get moving here. Welcome to Investors Edge Wednesday, or sorry, it's Thursday already. Holy cow. Thursday live stream. Kyle is here with me. I missed you last week. What's up, man? How are you?
Yeah, likewise. How's it going? And welcome everyone.
Good. Kyle's working with a new camera. We'll get that straightened out eventually.
Yeah, you
But
can way too detailed.
that's all right. You're looking good though, man. Nice haircut.
Yeah, yeah.
All right. So yeah, lots going on. Busy market, selling off. Lots to cover. So thanks for joining us, everybody, and we will try to make sense of this this busy market. Uh,
Yeah.
all right, let's go like this. Screen share both, and let's roll. All right. So we are Inside Edge Capital Management. We are an RIA based in Saratoga Springs, New York. We're active management, comprehensive financial planning. Kyle, what's going on? Opening thoughts here, man. What's going on with you? We've been heads
Yeah,
down jamming. Markets keeping
yeah.
me busy. I know clients in planning, keeping you busy. What's up with you?
I mean, that's it. It's been busy. And then yeah, a lot going on here. Bringing on some new clients, bringing doing a lot of trading. So we've seen a bit of a buying opportunity perhaps this week. So trying to decide and work with clients on moving cash in and setting up a plan to try and navigate this market. But
Nice.
on a personal note, if you're as you know, I'm a Texas Tech guy, and game day, college game day, is in Lubbock this week. So um, that's a big deal for us. And last time that happened was actually my freshman year, like 15, no, 17 years ago.
Oh
So
my God. Are you obviously
yeah,
you're going?
I'm thinking about it. Yeah,
Nice,
I'm
man.
I'm thinking about it. I have a lot of friends that are going, and I might make my mind up like Saturday morning and just head up there. We'll see.
Very cool. Very cool.
Yeah,
Um, let's see here. All right. So let's get rolling here. Right to the point. I know you guys are your time is time is tight. Markets are busy. Um, let's just hit it up at the top. Yeah, longer term, I think we're definitely in a secular AI driven boom. I think we have some valuation concerns. We have a Fed that threw us a curveball at the last meeting. We're going to talk about that. We're, I'd say, about 2/3 of the way through Q3 earnings, which generally have been good. I think we rally and we are, I think, quite higher here, 6 to 12 months out. So we kind of have a new bearish, neutral, bullish scale here we're doing on this Thursday. So longer term, I think we're well at a 3 in terms of longer term bullish. Intermediate term over the next 1 to 3 months into the end of the year, I would put us at about a 1 to 2 still on the bullish scale. We may have some volatility here. We already have some volatility, but whether it
yeah,
straightens out around November, we shall see. And then within the month, heading through Thanksgiving, which can be a very volatile period. I remember trading for an FX hedge fund way back, and there's a couple bouts of significant volatility right around Thanksgiving. So I'm going to put us at a 0 right now, neither bearish nor bullish as the market's pulling back here. Kyle, what do you think's
and
going on from your end?
and Todd, this is with the sell-off we've had, just
Correct.
to clarify for everyone. So yeah,
Correct.
this
Yep.
is this is with the pullback, which at this point seems like a sanity check on the bull market that we've been in. So, while it's a pretty sharp sell off these last couple weeks, I think it's you put it into context with how things have done the rest of this year and last year. And it doesn't look as scary when you're retracing the kind of gains that we've been seeing.
Right.
Also, I've had this conversation with a couple clients, and I think this chart is a good kind of lead into that. But the idea of what risk really is. So there's two ways to look at risk. Short-term volatility is the most common. When you see a large market drop, you see your portfolio balances go down almost instantly. That is a very real risk. It's volatility, but what we've seen is with all those previous drops that we've been in is that we always recover. So the real risk, in our opinion, is purchasing power and basically not having exposure to equities.
Okay. Good. All right. The risk, let me say that again. Put a punch on that. The risk is not having exposure to equities, right?
Right.
Put an
So
exclamation point on that, right?
so yeah, the idea is that,
Oh,
if you don't own the equities through the volatility, that you don't get rewarded when they go up over time.
yeah. All right. Good, good, good. Well said. So let's go here. Oh, that's you. I gotta get better on my hotkeys. All right. What else? Let's have some fun at the start. Just want to hit you with that new bull bear scale at the top. I was kind of updating what's going on, at least on my end. Just my daughter's 7. She thinks she's Taylor Swift. She had a little birthday party. That was kind of funny. What else is going on? This is kind of tying into the theme that we're going to hit today. We were at a ski shop in Vermont last weekend. And Brody had, one of my twins had ACL surgery and his knee is sort of out of alignment here. So being that the theme of our business is inside edge capital, that I was a D1 ski racer in college, you got to make sure your equipment is set up properly because, ski racing over 2 minutes, 1/2 degree out of alignment in terms of riding a flat ski can cost you multiple places. And plus his knee is all jacked up. So we had to get him straight at the ski shop in Vermont, no chemo. This guy is excellent. So it was kind of funny. I walked in and a picture hanging on the wall was, and her dad asked me to take the scratch off of her name. I wanted to protect her privacy. I didn't take it off, but it's okay. Her name is Lulu. Let's go with that. She's a client of Inside Edge, and she was borderline U.S. ski team throwing a flip with some kind of cross in there. I was a ski racer. I don't know the tricks, but it was kind of cool to see a Inside Edge client up on the wall coming in here. So kind of goes right along the theme of making sure that your equipment is dialed in, making sure your plan is set, your tax strategy is set, you've bucketed risk and understand what purpose these different accounts serve, duration, expected vol, purpose, goals. You got to have your game plan squared away because when things get tested like they are now, it's easy to let emotions get the best of you and make a bad decision. So got to make sure you're squared away. All right. So the big thing that we're seeing is there's 4 or 5 risks that I am going to borrow from my friend and trusted resource Tom Lee from FS Insight. I thought this was a funny Seinfeld graphic. Markets climbing the wall of worry, government shutdown, hawkish Fed, some stress in the repo market, the New York City mayor's race, which is really interesting, crypto deleveraging and private credit stress. So the concern, as we kind of opened with, is there a market avalanche coming? And again, going along with the skiing inside edge theme. Well, we got a pullback, and everybody is not everybody. A lot of people are really concerned outside of our circles in the traditional and in the social media realm. Kyle, the market is 3% off of all-time highs. Like, just step back and think about that. Like, we're 3% off of all-time highs. The S&P 500 has traded down just below the 20-day moving average. 20-day moving average is the average closing price last 20 days. We have an uptrend line here from the summer connecting into September, late September. So that's going to come in right around 6,700. Then you have the 50-day moving average. Then you have the 200-day moving average. Big question is, are we going to hold support here? Very possibly. I don't know. We can't know, but context is desperately needed here that we're 3% off of all-time highs of a market that, I'll put some percent returns in the broader averages in the sectors here, and it'll give you context like what a great year we've had.
Mhm.
Go ahead, Kyle.
I was just going to say sometimes, it makes more sense, and it's a better idea to look at a decline in terms of percentages. I mean, if you're
Yes.
started a few years ago and you've seen the type of gains that the broad market has, I mean, it does seem like you're protecting a lot of, in a position where you would want to protect a lot of gains. You see the dollar values, 1% drop is more than it used to be, or 3% drop is more than it used to be, and it just
Right.
tugs on those emotions a bit. So I think you make a good point. Like, look at it in terms of percentages and not always in just dollar value.
I don't know if I was writing this or it was a conversation. Here, I'll get my face in there real close so I match you.
I'm gonna back up.
There
Feel
you
like I'm
go. We got Kyle a new camera. He's been working working a lot
still,
with clients, everything. We'll get you squared on the tech, but you look fine.
yeah, I'll
I don't
keep
know.
my head the same size.
I was writing something. I don't know if it was the savvy trader clients or what, but like even our bigger clients, like I'm thinking of one in particular. He's a multi millionaire who's a friend and mentor of mine, and he's like, "Oh my God, these dollar figures I'm seeing are massive," and this guy is extremely accomplished. I'm like, I won't say his name, but I'm like, you have to look at it in terms of percentages. When you look at numbers, especially when people get in retirement age, out of the earning years and those numbers are moving up and down, it's scary, right? But you
Hmm.
have to think of it in terms of percentages because percent is relative to the expanded market value, the market cap, each client's individual net worth, and back into the plan. Like percentages keep it, it mitigates emotions and it keeps you on track and on plan. We can't overstate that enough. So you
Totally.
got to think about it in percentages.
Yep.
All right, let's keep pushing. All right, so kind of going down Tom Lee's list that the market climbs the wall of worry. So we're in the 36th day of government shutdown. Poly market, as of I think I captured this around noon, has a 47% chance of not reopening before November 16th. And again, that's an hour or two old. We're starting to see flight cancellations beginning. I was going to go out to Texas and see you, Kyle, and a couple clients that I'm long overdue to go out and see, but it's getting a little crazy at the end of the year. I really didn't want to deal with flight shutdown. So, we had
Yep.
a pretty good dip.
Understandable.
Yeah. Yeah. So the orange right here is November 16th or later at 47%. It was down around 30 something percent a week ago and it shot back up. So the highest probability is not for another 10 days. So we'll see what happens there. So that's causing concern. We're not getting some economic data. We're also, worrying about a slowdown in the government sector of the economy. The other thing that's interesting, and it hits home up here, is the New York City mayoral. I think that's the right way to say it. Election. We have a socialist Democrat coming in. And it's interesting. He's looking to enact a mandate, and boy, there's quite an uproar. And being that I'm 3 hours north of New York City, and I did order this book. I wanted to read it, Kyle. Don't think I'm crazy, and I'm going to get a screenshot probably online. But I wanted to read it and just to understand where they're coming from, because as a market participant, portfolio manager, you've got to set any political biases you have aside, look at both sides and see how it filters through, and price action is, and the market is filtering and interpreting the political data that's coming in. And many times there's not a big correlation between the two, but
Mhm.
we'll see. And I can't help but notice, I was like, there's definitely going to be some people fleeing from New York City because the stats that are going around of the percentages of people that that pay the majority provide the tax revenue in New York City is significant. So we're got to think that there's going to be a continued exodus like we saw in COVID out. And I just on
Yep.
Zillow, I was like, I saw a little uptick in the first week of November, and that's in a time where interest rates, which we'll talk about, are going up. So there's certainly even Zillow is starting to discount in maybe a flight to upstate New York out of New York City, and certainly into Florida and other more tax I would say
I'm
how do I
sure
say this, shelter places. Go ahead.
we'll see a few New Yorkers in Texas and Austin, I'm sure,
Yeah. Yeah.
heading
Yeah.
down.
So yeah, that was interesting. There's been a lot going on here. So, as I mentioned, the Fed kind of threw cold water on a December rate hike, or sorry, rate cut. They cut rates down to 3.75 to 4.0. There was a pretty good possibility heading into the meeting that they were going to cut again in December. Powell's like, hang on, this is not a foregone conclusion. Um, so, that kind of threw the market into a bit of a tizzy. He also mentioned that the end of quantitative tightening is here. And quantitative tightening is essentially it's letting maturing treasuries as mortgage securities roll off, not reinvesting the proceeds, right? So that's the idea of quantitative tightening. So if they if they so again, what they're doing is they're taking the $8.9 trillion Fed balance sheet as maturities were rolling off. They were not rebuying mortgage and treasury securities in the system, which is re-injecting liquidity into the system. And the more liquidity, the more it's going to chase asset prices up. So they withdrew some liquidity out of the system down to 6.5. So while he said December rate cut is not a foregone conclusion, we're done shrinking the balance sheet. So they are going to take the proceeds from maturing bonds and reinvest them into short-term treasury. So in one regard, they're no longer sucking liquidity out of the system, but they're not going to let the balance sheet get any lower, especially with the market volatility. So this really threw us for a loop. But heading into December 10th, which is the next meeting, we're at a 69% chance of going from 375 to 4 down to 35 to 375, which is another 0.25%. So looks like we're going to get another Fed rate cut, especially if the market stays volatile through the month of November, which we shall see. Thoughts, my man?
Yeah, just looking at inflation and it being still, I think it was 3.2. So if you compare that to where rates are, that's a little less than 1% above. So I think it's kind of from that standpoint, based on how they've acted historically when they're trying to temper inflation, they're usually about 1% above. So if you did take
Yep.
that 1% above, they would they'd want to stay where they are now. So I think it depends a lot. I think it'll depend a lot on where inflation comes in for this month. And then, I mean, we'll see if we can get any updated jobs numbers or if we're just going to have to continue to rely on ADP. But that'll be the other big one is is this consumer, in full employment economy starting to crack a little bit, or is it still, pretty good where we are?
Right. And that's the big question is the labor market numbers. Are we in a new normal of job displacement with AI? The demographics in terms of baby boomers no longer in the workforce, immigration policies changing. Do we just have a new norm? So,
Hmm.
the dual mandate of the Fed is maximum employment and price stability. Price stability is inflation, and maximum employment is everyone who wants a job. The Fed wants to see that they get a job. Well, is
Hmm.
the is the denominator of that labor force shrinking, and what's the reason for that? Is it slowing hiring out of corporates, or is it just increased efficiency, which will justify the higher multiples, that the market is struggling with? So
Yeah.
that's the question.
And
Um,
on the AI thing, I mean,
yep.
go back to the invention of the plow, right? Like there's been so many times technology has moved forward and people are like, what are we going to do all day now? I mean,
Yeah.
you see it time and time again. So I'm skeptical. I've read that and heard that be mentioned so many times, but I'm just skeptical of it.
God, I was bringing Brody to PT last night. We were talking. He's got a sixth grade social studies test today. We're talking about oh man, the what is it, 2 million BC to 10,000 BC, the Paleonthopic, and then I forgot the
It's
two time frames. I'm sounding like an idiot, but when
Jurassic.
these, what is it?
I don't know, Jurassic.
No, it was something when we started farming food and we started planting and farming food. That was the transition out of the two periods. So we were just talking about. Hope Brody gets it right
Yeah,
because I forgot the name of it. We were talking to ChatGPT in the car as we're going over and reviewing the facts for his test, which is kind of funny.
like Paleolithic age,
I
something
think
like that.
yeah, that might have been it.
Yeah,
Um,
caveman.
All right. So the other thing that is going on is we just had a big crypto deleveraging. So this really just happened recently. It was a violent leverage unwind. Um, it's a combination of a couple stablecoin projects that sort of got milked. The global crypto market, they went through kind of a flash crash in their own, dropped from about 4.6 trillion to 3.4 trillion, 1.2 wiped out. October 10th, market saw one of the largest single day liquidation events. Tom Lee, who's now invested with his Bitmine immersion BMNR, which is a stock we traded, um, said it's the biggest event in crypto history. So that's another sort of reason that the market is climbing the wall of worry. And the question is, are we going to have a continued avalanche? Which again, an avalanche, I'm being a little dramatic in that we're 3% off all-time highs, or is it just a pullback? The other thing that threw the market this week is Michael Berry, after 2 years, reappeared on Twitter. And freaking Hollywood, I'm sorry, but you make a big deal of someone who caught lightning in a bottle once, shorted the housing market, and I don't think has had a good trade since. Sort of similar, like
Yeah,
John Paulson was another one who was short the housing market, and he was made a god, and he's had several bold calls that haven't played out since. Well, Michael Berry appears from the Big Short, and he says after 2 years that sometimes we see bubbles, sometimes there's something to do about it, sometimes the only move's not to play. Like he writes these cryptic message and everyone in the social and traditional media goes crazy. And then the 13F filing comes out for Scion, and he shows he has short positions in Palantir and Nvidia. And of course, people go crazy. They're like, oh my God, he's short like 5 million shares of Palantir and 1 million shares of Nvidia. No, it's the notional value, it's the amount of put premium he has that controls this amount of shares, right? So there's a lot of confusion out there. Is he really, does he have 80% of Scion Capital net short or not? And I didn't include this other tweet, but then he comes in and says it's a joke how people are going through the 13F filings as the news media is reporting it and getting it wrong, which is essentially the spirit of his text. So he just plays these games and writes in these cryptic messages like it's so people are fixated on that, which again, November is historically a bumpy period and it's just kind of adding some of the fuel to the fire. So take that for what you will.
yeah.
Um, all right, so let's look what's actually happening. I love looking at the relative rotation graphs. Let's look at the major asset classes as they chart out here on the last 12 months. Okay, so the asset classes we're looking at here benchmark around the Vanguard Balance Index funds, which has a little bit of everything in it. We're looking at gold. We're looking at the NASDAQ S&P, the US dollar, commodities, government treasuries, commodity index, investment grade, corporate bonds, junk corporate, high yield corporate bonds, which is junk. So, basically what we're doing here is these lines or these tails represent 12 months of relative performance around this central benchmark. So basically what this thing does is it rotates in a clockwise fashion. And as you move from down here in the basement up to improving, this is like trying to stage a recovery. Over here, if you're on the right side, you're showing outperformance, relative strength, and relative momentum to a central benchmark, which is this VBINX Vanguard Balance Index Fund. Gold, as we know, has been ripping. Okay, gold is so far up in the leading quadrant. Gold in the last 12 months is up 49%. Okay, so significant. All right, so also here in the left in the improving quadrant, DJP, which is commodities, which have had a nice run. Okay, it's precious, it's industrial, it's softs, it's ags. We also have a bunch of bonds in there: high yield, government bonds, so on and so forth. So we have a lot of fixed income, government and corporate, trying to rally up, moving from the improving. Which again, if you're on this side, this hemisphere, you're underperforming the Vanguard Balance Index Fund. But you're starting to pick up some momentum and you're trying to shift to this hemisphere, which is outperformance. So a lot of the bonds and the commodities we're trying, but look at high yield, HYG, some of these government, they're starting to roll back over. So bonds were trying to overtake equities, but it looks like they're failing. At the same time, NASDAQ and the S&P are existing on the far right side, which is outperformance to your balance index fund, but you're also seeing a hook back up. And when you go from the weakening quadrant up to the improving quadrant, you don't do a full hook. That's very, very bullish. So the big thing we're seeing is the NASDAQ tried to move from weakening into the lagging quadrant, but just did a hard turn back to the north. So we're 1 or 2 months away from being back into leading, which I can almost guarantee that the bonds ETFs are going to back away. The dollar was in the toilet, shot straight up, and then rejected back. Now, what you're going to find is as the dollar was moving up, so was gold. So that's a flight to safety. Central banks diversifying around the world because of Trump's protectionist policies. But I think that with the dollar now dropping away, that's going to be a boost to equities because traditionally the US dollar across FX around the world has an inverse relationship to our equity prices. So if bonds back away, gold starts to roll over a touch, and the equities start to move up, I think we're going to continue to rally hard into next year. Okay, there's a lot there, I know. Technicals of the NASDAQ. So this is the weekly and this is the daily. So putting our technical hats on here, there's some ratio analysis that we do looking at the size of the swings that bring us up to key levels or bring our attention to key levels. In the NASDAQ 100 QQQ, there's a zone that we identified ahead of time at 629 to 640 that could be a potential ceiling in the market. The good news is we saw it ahead of time. The bad news is it's working, and I'm giving the market the benefit of the doubt for now. Okay, this is weekly, this is the daily. So again, when I say, Kyle and I are joking, the market's 3% off all-time highs, that's it. This is the pullback that we're seeing. So, we'll see. Are we going to go down and test the 20-day moving average? As of now, we're through it. 50 days here and the 200 days here. Okay, so we're going to be judging and watching very carefully next week to see if we can start to get some stabilization. And we're going to do a lot of sector work. We're going to do a lot of sentiment work. We're going to look at the data, the fundamentals, and figure out, do we have lower to go? Will we go test the 200-day moving average? Will we really back away from this zone on the weekly and maybe go back and test the breakout from last year? I don't think so. Okay, but we're going to be watching closely and making the best moves in real time at the hard right edge of the chart, so to speak. Sector rotation, and this is part of this is one of the tools that we use to figure out, which of the 11 sectors are leading the market on the upside, or the 11 sectors that are pulling it on the downside, acting as defense, so on and so forth. So still using these rotations. the 11 sectors that make up the S&P 500 are here. So, what I see, which is interesting over the last 6 months, is technology has made a big, strong turn up into the leading quadrant, which means technology is outperforming the central benchmark, which is the S&P, and technology is 36% of the S&P. So, that just shows you how much tech is outperforming the other, 64% of the market. The other thing we're seeing is utilities are moving in, and it's utilities that are power generating to the AI bubble. It's not the defensive, high yielding guys where money's flying into safety. It's the power generation name that's fueling the tech move. All right. So, we've tech and utilities moving in. Financials and communications are on the right side, but you can see the trajectory is leading them out. And I'd like to see XLC, which is Google and Meta and Spotify and Netflix, start to do the hook back up, but we'll see. So that's the monthly. Here's the last 8 weeks. What I really like is here on the weekly. Again, this is 4, 5, 6 points, right? 8 points. So the last 8 weeks, we got a hook back up in tech. Interesting. Utilities are going. Healthcare has come on sharply. Utilities, we already mentioned. Consumer discretionary, I'm watching this one. This is starting to head out a little bit. It's also on a negative heading here. So that's even with Amazon that did so well. Tesla's up at the highs. Consumer discretionary in general showing some weakness. So that's kind of a cause for concern.
Mhm.
Okay. The breadth is certainly weakening because tech and semis and Mag 7 are leading it for sure. Breadth is weakening. I do want to watch the consumer discretionary below Amazon and Tesla. Home Depot and Lowe's and Chipotle is on the floor. So consumer discretionary is
DoorDash,
going to, what's that? DoorDash?
DoorDash, DoorDash yesterday, they beat earnings, but the stock got crushed. So
Yep.
that I thought that was interesting. But
Yep.
I've definitely seen it in the consumer discretionary side too.
Yep, exactly. Exactly. And then healthcare is one that we're going to watch. The healthcare names that we're seeing, break out from good solid bases are not defensive lower beta names. They're new age, they're genomics, they're companies that are embracing AI to move in. So, from a sector rotation point of view, from where I see with XLY being the one cautionary tale, I think that means the index is holding support levels that we mentioned. All right, so let's just look at the sector report cards. Quarter to date, okay, we're in Q4. In Q4, XLK technology is up 4.69%. For the year, Kyle, would you believe that technology is up 26.9% for the year? And I captured these this morning.
Yeah, that's pretty crazy,
After,
especially
yeah.
after the run it's been on, and then everything we've heard about it. Just seeing it being so volatile, and yeah, it's crazy.
And the big dump in Q1 as well. So from
Yep.
the April lows, I think we're up 40 something percent from the Q1 lows. So quarter to date, so tech is up 4.6, healthcare is up 4.66. Here's the Nasdaq QQQ 3.8, utilities, S&P, small caps, and then you can read on down: energy, financials, real estate, staples, communications, materials. Okay, for the year, and this is a lot bit more important. The only one that's negative on the year are defensive staples. Kyle, like, as much as you want to be risk averse, as much as the market's climbing the wall, where as much macro overhang as there is, can you imagine being defensive and
Yeah.
being in healthcare, energy, materials, which should be doing better, real estate and staples? Like, you put an index of those bottom 4 or 5 sectors together, you're probably up 2%, probably break even net of inflation for the year. Like, I mean, that's with the tech market up 27%.
Yeah. The most value based portfolios have just underperformed this year is what we've seen. It's I guess if you want to look at it this way, it's good if you're getting a nice dividend at a lower price and you're reinvesting it. Maybe that helps you out later when we see value rotate back in. But yeah, as far as this year goes, certainly underperforming. I'll kind of paraphrase this, but I did a portfolio analysis for a new client yesterday. his 93% stock portfolio on a risk return basis, so measuring the each stock based on its individual risk, was basically the equivalent of a 80% stock portfolio in our models that was split between growth and value. So just showing, there's a lot of stocks out there where you're really not getting return for the amount of risk because they're still stocks, they still move with the market, but not getting the amount of return you want for the risk,
Yep.
even though I'm sure you're getting a nice dividend. So
Well,
that's not never a bad thing.
well said. Well said. All right, let's keep moving. Okay. This is from Ed Yardeni, another resource who, probably 40 years of Wall Street experience, wonderful research newsletter. I think he charges $30 a month. If you're interested in fundamentals and macro, I highly recommend him. Yardeni.com. And there's been a lot of comparison of the AI build out now to the 2000 tech. And Ed's a very sensible, sets the sensationalism aside. And this is just a quote from his piece. Today, the S&P 500 tech and comm services sector combined accounted for more than a 45% of the S&P's market cap. So the concern and the bell people are ringing was, Mag 7 is such a large percent of the overall S&P 500 market cap and 38% of its earnings. So there's more earnings support for the current tech bubble than the one in the late 90s. There isn't as much air in the current bubble. It's likely to burst, though. It isn't likely to burst, though it might leak some air from time to time. So basically what he's saying is, even though it's 45% of the S&P's market cap in blue, the forward earnings represents 38% of the S&P's earnings. The gap between these two is nowhere near the gap that we saw in 2000. 40 something percent of tech was the market cap of the S&P in 2000, with only 25% or so of its earnings. The gap here is much smaller. And as long as these large mega cap companies can continue to drive earnings, raise forward guidance, and deliver on that, this is not a bubble. A bubble is unrealistic, crazy price action that's completely disconnected from the reality and the underlying earnings, because at the end of the day, what drives the stock market is earnings and expectations of earnings and strong guidance from management that they're going to continue to earn. And right now, the backlogs for what we're seeing are there. So it's, is, as he said, will it leak some air time to time? Yeah. But, until you start to see a disconnect here between earnings and market cap representation, this is not a bubble.
Yeah, it's hard to believe, but there are still companies trading at a discount based on forward earnings. It's a little crazy with
Yeah,
how things are done, but it's
you
true.
and I were just going back and forth looking at Meta too. Like, I wanted to put that in this presentation, like how cheap Meta is on this pullback. I didn't have time to put it in, but on a valuation point of view, Meta has been underperforming. Like, it's a deal right now. Nvidia trading 35 times forward earnings. Like, this is not expensive.
Yeah.
All right. How we doing? Okay. So there's just, and the other thing that's driving people crazy is Sam Altman and OpenAI. It's a $1 trillion private company. Nobody really understands how much money they make. There's so much stuff I could have put in this presentation. Like, my head is going to explode here once this presentation's over. Like, this one got hurt. Like, there's so much stuff happening right now. But
Seriously, yeah.
like in every week I talked, I'm always looking at the Brad Gerstner BG2 podcast from Altimeter Capital. Him and Sam Altman got in a little pissing match with each other. And Brad Gerstner asked Sam Altman, like, how are you going to invest $1 trillion into these various companies, these suppliers to OpenAI, when you only have $100 billion in revenue? Oh, what'd he say? No, 14 billion, I think he said, whatever. And Sam Altman got a little defensive, and he's like, we make a lot more than that. And he's like, if you want to sell your shares, Brad, I'm sure I can find someone to buy them. And he's like, it was kind of a little pissing match. It was funny, but nobody knows really how much money OpenAI is making, but how are they going to continue to make this? Like this big web of investments between all the AI leaders is causing some people's heads to explode.
Yeah, it just seems like it's time for them to IPO, but
Yeah,
I can see they wouldn't want to yet, but
it
yeah,
and he
seems
said
time.
something like, somebody said 26, and then I think he pushed back on Brad Gerstner again. He's like, maybe we'll, no point, maybe 27, push that back. I don't know. He's kind of annoying, but
They've come a long way from being a nonprofit a few years ago
good
when Elon started it.
good point.
Which,
Good point. All right, so OpenAI $38 billion cloud deal with Amazon, and this is on top of Amazon posting huge numbers, which we'll talk about. The deal announced Monday positions Amazon's major infrastructure provider for Microsoft's AI. Insatiable demand. This is from GeekWire. It comes as Microsoft, Amazon, big tech companies attempt to reassure investors who've grown concerned about a possible bubble in AI spending infrastructure investment. OpenAI is slated to begin running AI workloads on AWS, which uses hundreds of thousands of NVIDIA GPUs. The other thing that makes it tough is like NVIDIA comes in at the very end of each earnings season. I think it's November 19th is NVIDIA earnings. Like, I almost think the market's taking profits ahead of the NVIDIA earnings report. Like, this one could be absolutely bonkers. And NVIDIA is hanging in pretty well.
yeah, it has
Uh,
been. And
so,
yeah, I
yeah,
mean,
go ahead.
there's so much going on, and then you have to, I mean, you don't have to. I guess you would think there's just got to be some profit taking happening on top of all this other news. Like things have been so good. I mean, why do people invest? There's gonna be people out there taking profits, using some of that cash to live or to do things. It just is. It's the way it is,
Yeah. Yeah, absolutely.
and it's
Uh,
seasonal.
and it's seasonal.
Yeah.
So this is just kind of a fun from ChatGPT. Just give me a chronology of all of the OpenAI deals that have been done this year. Stargate, Oracle, Nvidia, Broadcom, AWS. Like the amount of deals this company's doing. Like, and the fact that we don't have any visibility inside the financials of this company and it being it's so center to everything that's going on, like that's what's causing more confusion. And I know for me, like, I'm branching out. I'm using Perplexity more and more now. I'm using Grok somewhat. Grok is very conversational. I use ChatGPT all
Mhm.
the time, but to speed research and get through massive information I used to have to read, like it's a game changer. It's absolutely amazing. My kids are using it. My wife's using it, and there's options out there. So it's pretty
Yeah.
revolutionary stuff. My parents are using it.
Absolutely. And I mean, we've covered this. We wouldn't say it every time because then people would be like, all right, please stop. But I mean, the winners in these non-technology industries, and then the winners, I guess, on an individual level too, it's going to be who uses AI the most efficiently and the best way to achieve their goals, whether it's a large corporation or a student or anyone. I mean, it just makes you so much more effective if you use it the right way.
Yep. Yep.
Yeah.
Absolutely. I had to have the talk with, we got a letter home from school for everyone. They're like, talk to your kids about proper use of sourcing information and citing. And so we have to explain to our 11-year-old twins, like, you can't just go to ChatGPT copy answers. Like
Yeah.
we have like to
Yeah.
talk to them at that level. Like you have to use it as a research tool, make some
Hmm.
notes and then reformat it in your own words and have your own thoughts on it. They're like, okay, Dad, I got you.
Yeah. You have to do the interpretation because I mean I realized very early on that AI loves to agree with you
Yes,
on like
correct.
everything.
Yep,
So
yep.
it's just like great idea. It's like no, use it for information, and then you've got to interpret it and double check everything and make sure it's not just like trying to make you happy and tell you you're right because it
It's
totally
true.
does
I mean,
that.
why wouldn't it? Like, they're trying to
Yeah,
get it, the longer you stay on, just like social media algorithms trying to keep you on and keep you around longer. Like, yeah,
yeah.
that's a good point. So Amazon was the big catch up. Amazon been underperforming even the broader S&P for all year. So this is the relative strength of Amazon to the SPY. So the blue and red line is the actual RS line to Amazon to the S&P. The gray line is a moving average of the RS ratio. Okay, so Amazon underperformed the S&P pretty much, right from the very top of early 2025 and had been continuing downward until just recently, where we just shot back above the moving averages of the weekly. And this corresponds with the Q3 earnings that just came out that were just blockbuster. So this is the gap. I mean, this is a Mag 7 company gapping from what, 225 to 246, $20, a 10% gap for, how many $1 trillion company. Absolutely amazing move. The earnings were crazy. The revenue expectation was 177 billion, came in at 180. EPS $1.57 came in at 195 at 24%. I mean, that's almost an Nvidia surprise in the early days. Like 24% EPS surprise on Mag 7. That's crazy. And the big one was AWS. AWS experienced a significant growth rate acceleration, 202% year-over-year increase, making it the largest growth rate in 11 quarters. The backlog reached 200 billion, showcasing strong future demand, innovation in AI, robotics. Like Amazon is innovating very, very sharply. So we've got a fundamental catalyst behind the breakout through technicals. We gap through this, just a simple downtrend resistance line. So this is something you'd call a breakaway gap on massive volume. You've got to wonder if institutions are going to support it in the 238 region. And I'm kind of wanting to see what the market's doing. I just want to keep an eye on things here. Okay. And in fact, I can just pull this over quickly. We haven't really moved that much. Oh, that's so nasty. Here's Amazon right here. So we're trading 244 right now. Here's the NASDAQ down 2.5%. We're right at that 20-day. Got a breakout here. So just watching how the market is progressing. And this is a live chart from what I put in the presentation. So things seem to have stabilized for now. It's 12:40 lunchtime in New York. So we'll see what happens in the afternoon. Palantir was another one. Amazing earnings, 1.09 billion expected, came in at 1.18 billion. Earnings of only 15 cents, came in at 21 cents, 40% EPS beat. You see the revenue growth. I know those figures are very small, but Palantir was another one. This is like the Nvidia of software companies. And Palantir, people mistakenly think that it's primarily a government contract source revenue, but they're like 70-80% of the revenues. No, sorry. It's like 60-40 government contract versus commercial. And there was a interview with Jensen Huang and Alex Karp, two CEOs of NVIDIA and Palantir together. And, they just did a deal together. And Alex Karp was talking all about the commercial application of Palantir software and how NVIDIA hardware is going to power that. If they can really tap into the commercial, have commercial exceed their government contracts, and they can, become embedded in a lot of corporations, like the total addressable market is massive for Palantir. Valuation is really, really obscene, and we'll have to save it for next week to talk about that. And there was some profit taking coming in, okay? But again, we're at 208. We go down to 180, 85, whatever. The stock's up hundreds of percent this year. To have a 20-25% sell-off is not that extreme. Okay, that's how markets move. We go 3 steps forward, 2 steps back, 3 steps forward, 2 steps back. So the market is continuing to climb the wall. We're in this very unknown AI build out. Closing thoughts, sir.
I mean, on Amazon, and if you doubted how important AWS was, think back to when it went down a couple weeks ago, or was it last week? And like
point.
half the internet was
We couldn't
like
do
off.
anything.
Which is it highlights how important it is, but it's also, I'm like, how, the cloud can be scary. If it goes down, that's a big deal. And then, what actually caused that to go down and what did they need to fix? Like
Yeah.
it's something I want to understand more.
When did that happen? God, there's so much going through my mind.
It was recent,
No, I
but it does
know.
seem like a month ago.
No, but I noticed like when it happened, the stock didn't do anything. And I was like, there's relative
Yeah,
strength in this. And then it comes out. When
the
did
21st
21st of October?
October, yeah.
So
Or Monday, sorry, Monday is when it started, the 20th.
20th.
Yeah.
Okay. So
And
I mean
then
that's how crazy markets work. Like let me go um let me share screen here. So it was the 20th, you said?
yeah, October 20.
Is that you're positive that was the date that AWS went down?
Yeah.
Okay. So we had already been selling off. The fact that when AWS goes down and brings down whatever percent of the internet, the stock holds the 200-day, gaps up the next day, and then look what happens. Like that's how smart and forward looking the markets are. We rally into earnings and then earnings just explode topside. Like that's the kind of sign you're looking for in the markets. Like it should have sold off and it didn't. It's a
Yeah.
little bit of Monday morning quarterback on that one. And so there's serious underlying strength in here. And if we could hold the old technical breakout level in that zone, this is where you expect to see institutional support come in because there was a lot of buying coming in here. And there's institutions who are chasing on the upside who are very likely to defend if the broader market doesn't avalanche, as we showed you on the fourth and fifth slide of today's presentation. So it's going to be key. Dude, we're at
Yeah.
51 minutes. We got 9 minutes to go, man.
We're maximum efficiency.
Absolutely. Let's see what else we've got.
I'm gonna check comments.
Okay. So if you want, we our speedboat portfolio, Savvy Trader. This is Active Opps. This is our hyper active, very high beta, which is high volatility. We make it available for you to follow along if you like. It's, we've got about $3 million of money in there, real money. I'm trading it live. You can follow along at insideedgecapital.com/join. You get a full mobile app, text message, push notification. When I make a trade in Active Ops, you'll get notified right away. I put commentary in there every day and videos. And again, it's what I used to charge per month at Trading Analysis. I'm out of the research game. We're fully in the wealth management business, but it's fun. It's a good way to keep in touch with people who want to see what we're up to. Powered by Savvy Trader, which is great. So, Inside Edge Capital /join if you'd like to get involved and follow along on that. So there's the performance of what we've done. I launched this in April. I think we're up 40-45%. I think we're probably down to 37-38%. We certainly have some high octane names that have drawn down. We did cut the balance to DoorDash this morning. So yeah, so that's that if you're interested. Kyle and I want to thank you, and we are Inside Edge Capital Management, active individual equity portfolio management, as well as comprehensive planning. I can't overstate enough, especially when things get volatile, you've got to have that plan locked away, because there's so much. The news flow, the dissemination of information is so rapid right now. If you're not full-time focused on this, it can be pretty intimidating, but there's so much opportunity. Like you said, if you're just in staples and real estate and healthcare all year, you're up 2-3%, but if you're able to navigate technology, what did I say is up 24-25%? Okay. So if it goes down 2-3% right now and it chops into the end of the year at 2%, 3% in conservative stuff, compared to maybe a 20% year with some technology exposure that's properly managed. And you can't have that exposure unless you work with a certified financial planner. I don't know which side of the screen you see Kyle on,
Mm.
but Kyle is working his butt off with our clients, making sure they're squared away at the end of the year, planning tax status, updating their plans. Well, I mean, what else do you work on, Kyle? Tell
Yeah,
me, like, the
it's
further we're getting along, like in this business, the more we're building, like the less and less we talk to each other because we're so just, we're so buried in our own responsibilities that come together
yeah.
for the clients to make a good experience.
Yeah, it's all about service, and that's why we're busy because we're I mean, for every client, we're doing a financial plan. For every client, we're taking that plan. It has its own strategies, which some of them have nothing to do with your investments, and a lot of the conversation directly uh, dictates or helps us find the ideal way to manage your investments or to consult with you on how to manage your investments. So it's the whole process. We're doing it for every client, and when markets, I think at this point, when with markets at all-time highs, I mean, this could be a for many a good time to reevaluate whether you're kind of more on the sideline with cash and kind of not participating, and you're looking for a way, really not a way, but like a strategy to get some exposure. Or say you've been in growth stocks and you've been riding this up, are you looking to deconcentrate? Like we have, it's a wide range of conversations we have. We meet, try our best to meet people where they're at, and regardless of where that is, we guide you through conversations, through our technology tools, everything we can do to make sure you're in the best position for your own specific goals, preferences, etc.
Yeah, well said. It's such an exciting time. I mean, we've had so many clients come into us over the last 6 months, and we've been in a pretty hyper growth period with the assets under management that we have. And they're like, Todd, I've been following you for years on trading analysis, and the markets are fine. They were great. But they're like, I'm 60, 65. I love trading. I'm involved in the markets, but it's so busy. There's so much going on, and there's like, it's too much right now. And I'm like, you know what? And people feel guilty, or they say, boy, I just, they're like, I just don't have time. And like, we're saying, like, good. Like, this is not where day trading or even swing trading, like, it used to be fun and it used to be easier. It's a full-time job now. These markets are so dynamic and so busy. And I just feel like the rate of change of information dissemination and how quickly markets process stories, like it's not a hobby anymore. But
Right.
if you can position yourself and you're squared away with a good plan, there is opportunity that you can harness. And some of these, some of the names that are leading the AI revolution are creating like huge opportunities, but there's a lot of volatility in it. You got to have someone who's
Yeah.
full-time managing. And I'm not saying like we're smarter than you. We're not. Like, this is all we do. Like, there's many of our clients are
Yeah.
smarter than both Kyle and I, but this is our
Exactly.
full-time profession. We love it. And this is what we do all the time. Like, we want our clients to, jump into Savvy Trader, see what we're doing. If you want to take 10% of your account and trade and, have some fun with it, great. But I don't want you to stress,
Yeah.
because go enjoy your life and, let us create the opportunities for you, but stay involved in the markets if you want. But I'm telling you, it's a
Yeah.
different market than, I
It really
started.
is. And I mean, as much as we showcase like these Mag 7 and these stocks that are just crushing with all the earnings and all the growth prospects, like there is a huge amount of speculation on the other hand as well out there. So
Yep.
that's part of it too. I mean, you can look at a stock, it's up 200% this year, but it has no earnings, and it may look like a really good investment, but have you gone in and done the research? Do you know what the forecast is? Do you know if it's a good investment or if it's just speculation? Like that's something where
It,
it's so easy to look at something and be like, wow, this is great. But then you realize after, hopefully not after you buy it, that there wasn't really anything behind it.
but that's a really good point. I mean, this market in the AI build is not it's not trading on bottom line EPS. It's trading on top line growth. It's trading on
Yeah.
revenue growth and how much market share they could capture or innovation, product development in the future, 2 to 3 years out. Like, it's
Yeah.
crazy right now. Is it going to last forever? No. And the other thing, Kyle, Kyle runs a fixed income portfolio. Like, we had one of the worst bond markets in how long in 2022? Like, so bonds are not really,
4 years, yeah.
bonds aren't safety, with inflation pretty much embedded at 2-3%. Your fixed income portfolio is spitting off 4.5%. So your net yield is 2%. Like, that doesn't do anything
Yeah.
for you.
Yeah, it's on the bond side for us, and I mean, in reality, it's about limiting volatility and providing some inverse correlation to stocks. Stocks over time are where the historical returns are. I mean, any way you slice it up, like what a big part of what we do with more conservative investors is how much stock can you stomach based on whatever amount of risk is in that particular model. We have two models, so whichever risk is in that model we're recommending, and then how much fixed income or how much of that inverse correlation to stocks do you need to be in to stomach the volatility that we see in the stock market. And this needs its own presentation, but like back to the beginning, that's what risk premium is. The people that can put together a plan that allows them to be a long-term investor. Once you get that in place, keep as much cash and bonds as you need to have that sleeve growing for you, and letting it do its job, because all these pullbacks, bear markets, all these periods of long stagnation have been followed up by periods of astronomical stock market growth. So I mean, it's just the way it is. And
Well
and
said.
who knows what the future will be? We can't predict it, but we are going to use the past and look at how look at what the forecast looks like, obviously, but you have to look at the past too and just see the realities.
Yep. And here's another layer. Schwab is purchasing private equity force, making it available to our clients. So here's another layer we're going to have to look into, Kyle,
Absolutely.
which has been on our radar for a long time. And I'm like, clients want it.
Yep.
We're going to examine
Yep.
it. So book
We
a,
we do think, yeah, we'll definitely follow up on that.
yeah. Yep. So if you'd like to schedule a call with us, insideedgecapital.com, that big orange obnoxious button in the top right. There should be an intake form here, a few questions if you'd want to book and talk to us. Other than that, stay safe out there. I just booked the Park
And
City trip for February again. I can't wait. I love going out
oh,
there.
sweet.
Yeah. What are you going to
Real
say?
quick,
Yep.
the odd had a couple of questions in YouTube,
Okay.
and then Nate Miller, that's awesome. Hope y'all have fun at the tech game this weekend.
Oh, they're
And
good. Hold on.
if you want to catch up sometime, I'd love to meet you.
Oh,
Got
nice.
a
Nice. Is that in
fellow
YouTube?
tech guy in the chat. And
Oh,
then, I
cool.
mean, obviously that goes to everyone else. We would love to meet our listeners and get to know you and see what's going on in your world. And then Ziad asked what he thinks the impact would be if the tariffs were reversed. I
Yeah,
guess
they're
by
they're
the
they're in
court
they're in
ruling.
Supreme Court right now.
Yeah,
You know, I think we've seen some news rattlings of them potentially being reversed, and the market actually sold off on that news because of the loss of tariff revenue. So I actually think it would be a negative, because it's been nowhere near the bombshell that we thought it was going to be. And when Trump came in January 20th of 2025, market sold off hard into Q1. Everyone was saying that the protectionist onshoring, destabilization of global trade was going to crush us into recession or more, and didn't happen. I would say on the whole, it's generated revenue for this country and it's brought countries to the bargaining table. So I would say that the market sells off if the tariffs are ruled unconstitutional. What do you think, Kyle?
yeah. I mean, I would start with what I think it would do to the dollar. whether that would cause it to get stronger or weaker. And I don't have an answer to that. I mean, I think it's important to have a basis there. I also wonder if the tariffs, like, are they there to make money and bring in tariff revenue for the foreseeable, or was the reason we did them to get this onshoring with the new kind of phase of warehouses being automated and this kind of new production economy that we're going into where China was winning? Like, did we do enough there to where it's not gonna, like, it's kind of mission accomplished? So I don't really have an answer, but
It's such a
I think
complex.
it's very
It's
complex.
so complex, but I mean, I think that's a big reason why we're seeing utilities and industrial stocks act so strong because I mean, literally, we could be going back into production economy where, yeah, there's going to be AI robots building these facilities, but maintenance of data centers and how much infrastructure needs to be built within companies to bring AI into the future. Like, that's why utility stocks are acting like growth stocks. That's why, you got companies like
Yeah,
Vertiv, industrial cooling for, taking the power from the outside the data centers into the data centers. Like, it's a new world we're in, for sure. We're not going to go there in a straight line. There's going to be 5 and 10% pullbacks, but again, technology that was down 20% to start the year rallied 40% from there. Net we're up 25% of the year. Like, technology's up 25% of the year. It's been a hell of a year. Um, so I don't know. I think
still in
that's
early innings on AI, or maybe like mid innings,
yeah.
somewhere in there.
Did we hit any other questions that we might?
Uh, what what AI tools do you find helpful, and do you use Chat GPT to help with market analysis? And the
Yep,
answer to that is yes. I use
absolutely.
it for research, like informational purchase purposes.
Yep. Yep. And I've been using Perplexity a lot more. They have a good sort of finance tab to go through earnings. It's really challenging, when you're running portfolios on both a fundamental and technical basis, you've got to look at we're through mostly through Q3 earnings season right now. You got to look at there's several different earnings stats you got to look at. You got to look at non-GAAP EPS. You got to look at diluted EPS, which if they issue shares or something, you got to look at the increased share base that goes into the revenue to get EPS. You got to look at GAAP, non-GAAP, diluted. Then you got to look at forward guidance, and you got to figure out, and like all the different fundamental data sources have slightly different numbers of what the company reported. So you really got to aggregate the data and figure out where the earnings were on those three different metrics, and also what the forward guidance is, and why the stock is reacting. Um, so I went through Celsius this morning. I mean, I should have been finishing this presentation, but I looked at Celsius. Like, the diluted EPS was a loss, I think, of 27 cents when it was supposed to be zero, because there was like this divestiture of Alani Nu and Rockstar with Pepsi, which is their main distributor. Like, that the headline non-GAAP non-GAAP EPS, I think it was like 42 cents, was a beat. But if you look at the costs associated with this Pepsi deal, it was a big miss. And Celsius was getting crushed. And use of AI to look and recap a wide range of fundamental stocks is very helpful. So that's what I use it for. Um, do you use it to? I mean, how else do you use it, Kyle? Is there any other area you use it for?
Uh, Work wise, I mean, it's great for research. It's like my Google now, I would say.
Yeah.
When and Google's their AI has come a long way too, just in more recent months. But yeah,
Yeah.
it's when I have a question and I want to kind of type something in and then go work on something else and then come back to it and read through that and see if I learn anything and check, see if there's any good sources. I can then click from Grok is what I use mainly, and then,
Yeah.
you know, go down its list of pages that it found, and it's really nice.
Yeah. The big thing too is like Apple stock is hanging incredibly well. Google's bid,
Hmm.
because just by the way this is all shaken out, like Gemini and Google are going to be Apple's AI provider. Apple has this tendency of like using other people's hardware and infrastructure. They don't invest in their own massive data center of NVIDIA GPUs. They go and contract out someone else. Like I think Google
Right.
pays them 20 billion a year to place Google search
Yeah.
engine in Apple, but
With
Apple's
that
going to
court rule. Yeah.
and then Apple pays them a billion. Apple's going to pay a billion to access a bunch of to Google to access their GPU data centers, and Gemini is going to be embedded in Apple phones, and the Apple 17 upgrade cycle was shockingly good. People weren't expecting that, and Apple's at all-time highs, and Google as well. So as people are calling for the downfall because of what we're talking about with AI, in fact, the opposite's happening. If Google and Apple partner up to take on OpenAI, Amazon, and the others, like
Yeah.
there's a lot
And
of opportunity there.
Google's got the whole chain. They're like completely vertically integrated. I think the only other company as close to them is as accomplishing that is Amazon, but
Amazon. Yep.
they're more ahead on that, owning the whole AI infrastructure. So we'll see when they start building little small nuclear reactors and all that too.
SMRs. Oh man. I want an
Yeah,
SMR, but the power flashed out this
right.
morning. The power
Could we
flashed
fit
out when
one
I
in
was
my
prepping. Like
backyard?
everything went out. We had 60-mile-an-hour like wind warnings, and like, man, I need a nuclear reactor outside of my house.
Yeah, just put one in the backyard. Can like sell energy to my neighbors. Be great.
All right, let's wrap it up.
All right.
All right, thanks, boss. Good session. Thank you, everyone,
Yeah,
for
likewise.
listening. Sorry to go off the rails a little bit, but that's just kind of the market we're in right now. Um,
Yeah,
you know,
absolutely.
you're not going to get polished, professional, buttoned up suit and tie wealth managers. We're real deal. We live and
I do
breathe it.
like the cricket shirt, though.
Huh?
The cricket shirt.
Oh, yeah, that's your. This is my go-to. It's like your Austin brand. I love
Yeah,
this stuff.
straight out of Austin. Yeah,
It's my favorite. Like, it's good stuff. It holds in pretty well. I beat the crap out of my clothes, and
yeah. You can go on eBay and get them for a third of the cost.
what?
New. Yeah,
Really?
I bought it. Yeah, I just bought three. I think I got three things for like $120 off
Oh,
of
perfect.
eBay,
All
new
right, good
with
to know.
tags. Yeah, take it, right?
All right. I'm a sucker
All
for
right,
Instagram
guys.
shopping. All right, we got to get out of here.
Yeah. Thanks again. We'll see you guys next week and
Sounds
have a
good.
great rest of the week and weekend.
See y'all.
Bye.